3 out of 5 retirees stop working before 65, and nearly half retire earlier than they planned. Here is the counterintuitive part. If you are laid off at 60 and handle the next 3 documents correctly, you can finish with more lifetime wealth than someone who sleepwalks to 65. Not because losing 5 years of salary magically creates money. It does not. The advantage comes from severance, lower tax years, healthcare subsidies, and a larger Social Security benefit working together. Most people panic, treat each decision separately, and accidentally destroy the opportunity. The 2026 Retirement Confidence Survey found that the median worker expects to retire at 65. The median retiree actually stopped at 62. 3/4 of the people who retired earlier than planned said the reason was outside their control, including health problems and workplace changes. So your retirement date may not be your decision. Your response to it still is. There are 3 documents between a frightening layoff and a potentially richer retirement. The severance agreement controls your immediate runway. The Social Security guidelines determine whether you lock yourself into a permanently reduced income. And the healthcare laws decide whether the 5-year gap before Medicare costs a manageable amount or quietly consumes tens of thousands of dollars. If you like finance, explained by someone who reads the boring documents, subscribe. That is the entire job description here. Start with a severance agreement, because this is where people make decisions while their nervous system is trying to escape through the nearest window. Federal law does not generally require an employer to provide severance. The Department of Labor says severance is a matter of agreement between the employer and the employee. That sentence is important because an agreement is not a gift. Your employer is offering compensation in exchange for something it wants from you, usually a release of legal claims, confidentiality obligations, cooperation, or restrictions on what you can say afterward. The number at the top of the offer is not the whole package. You need the separation date, the payment date, the reason for separation, the health coverage end date, the treatment of unused vacation, the status of any bonus, and what happens to stock awards or pension benefits. Those dates can produce completely different tax, unemployment, and healthcare outcomes, even when the headline severance amount stays identical. Suppose you earn $120,000 and your company offers 1.5 weeks of pay for every year of service. After 20 years, that is 30 weeks of salary, or a little over $69,000. If you are planning to resign and retire, the employer might owe you none of that. A position elimination can turn the same departure into almost 7 months of funded retirement runway. Do not assume every company uses that formula. Some offer a fixed number of weeks, some cap service credit. Some provide salary continuation instead of a lump sum. Some offer additional benefits only to employees who sign the release. Your company's written plan, policy, employment contract, and offer control the result. The wording around your departure also matters, but it is not magical. Reduction in force, position eliminated, and layoff support the position that you left through no fault of your own. Voluntary resignation can create problems if you later apply for unemployment or challenge the separation. A state unemployment agency makes its own decision, so your employer cannot guarantee eligibility with one phrase. But you do not want to volunteer for damaging language because somebody in human resources said it was administrative. If the company gives you a choice between resigning today and being laid off next week, do not sign until you understand the consequences. A resignation can exchange severance, unemployment eligibility, and negotiating leverage for the privilege of making the paperwork easier for the company. That is an impressively bad trade. Employees who are at least 40 receive additional federal protections when a severance agreement asks them to waive age discrimination claims. An individual offer generally must provide at least 21 days to consider the agreement. A group termination program generally requires 45 days, along with information about the employees selected and the eligibility factors. After signing, the employee normally has 7 days to revoke the age claim waiver. That review period exists because the document was written by the company's lawyers to protect the company. It was not written to help you retire. The agreement should also advise you to consult an attorney. Spending a few $100s for a review can be rational when the document governs tens of thousands of dollars and releases rights you cannot recover later. The first negotiation is often not more cash, it is better timing. Severance is normally taxable wages. It can be subject to income tax withholding, Social Security tax, and Medicare tax. Payroll may withhold federal income tax using the supplemental wage rules, often at a flat 22%. That withholding is not your final tax rate. It is a prepayment. You could owe more or receive part of it back depending on your total income, deductions, filing status, and state taxes. If you are laid off in November after earning almost a full year's salary, adding a large severance payment in December can stack more income into an already expensive tax year. If the company is willing to make the payment in January, the same severance could land in a year with no salary and a lower marginal tax rate. This has to be negotiated before the money becomes available to you. The IRS uses a concept called constructive receipt. If a valid check was available in December, refusing to deposit it until January does not move the income into the next year. The payment terms need to create a real January payment obligation, and deferred compensation rules can complicate custom arrangements. Ask the employer whether the agreement can specify a later payment or installments, then have a tax professional review the language. Ask whether changing the payment schedule changes your benefits, unemployment treatment, or eligibility under the severance plan. Salary continuation may keep you on payroll longer. A lump sum may end employment immediately. Some states count severance against unemployment benefits while others treat it differently. One line can solve a federal tax problem and create a state unemployment problem. This is why the order matters. First, obtain the proposed agreement. Then, identify every date and form of compensation. Then, model the tax and healthcare consequences. Only after that should you negotiate the payment schedule. Health coverage is also negotiable. Your employer may agree to pay several months of COBRA premiums, continue its premium contribution temporarily, or increase the severance amount to cover insurance. Because health coverage can cost more than your mortgage, 3 months of employer-paid insurance may be worth more than an extra week of salary. Ask about unused paid time off, but understand that state law and company policy determine whether it must be paid. Ask whether a prorated bonus was already earned under the plan. Check the vesting date of restricted stock and options. Being separated 1 week before a vesting date can cost more than the severance itself. If you have a pension, ask whether delaying the official separation date changes your service credit or benefit calculation. Also look for a Worker Adjustment and Retraining Notification Act notice. Federal law generally requires covered employers with at least 100 employees to provide 60 calendar days of written notice before certain plant closings or mass layoffs affecting enough workers at a single site. There are exceptions, and not every layoff qualifies. When the law does apply and proper notice is missing, potential remedies can include back pay and benefits for the violation period. That is not the same thing as ordinary severance, and the two should not be casually combined in your head. Unemployment can add runway if you are still available for suitable work. Federal standards require claimants to be able to work, available to work, and actively seeking work, while states determine the details and benefit amounts. If you are genuinely considering another job, unemployment is part of the bridge. If you have decided you will never work again and refuse to search, it is not a retirement benefit wearing a fake mustache. The larger mistake arrives after the paperwork, when you confuse a missing paycheck with an emergency that Social Security must solve. At 60, you cannot claim retirement benefits yet. The earliest claiming age is 62. That gives you roughly 2 years before the first irreversible decision, and those 2 years are valuable. You can use severance, cash, taxable investments, part-time income, or retirement account withdrawals while leaving Social Security untouched. Stopping work at 60 does not automatically destroy your future benefit. Social Security generally calculates your retirement amount using your highest 35 years of indexed earnings. If you have fewer than 35 years, missing years count as zeros. If you already have 35 strong years, working longer can still replace lower earning years, but the effect may be smaller than people assume. Your Social Security statement can show estimates at different claiming ages, but make sure the projection is not assuming future earnings you will no longer receive. The claiming age adjustment is much larger. For someone born in 1960 or later, full retirement age is 67. Claiming at 62 can reduce the retirement benefit by 30%. Waiting beyond full retirement age earns delayed retirement credits until 70, reaching 8% per year for people born after 1942. There is no additional delayed credit for waiting beyond 70. Imagine your full retirement age benefit is $2,500 a month. Claiming at 62 produces approximately $1,750. Waiting until 70 produces approximately $3,100. That is a difference of $1,350 every month, or $16,200 every year. It continues for life, and future cost of living adjustments apply to the larger starting amount. The early benefit feels safer because money arrives sooner. That is the brain problem. You see 8 years without checks and classify those checks as lost. But Social Security is longevity insurance, not a competition to collect the first dollar. The relevant question is how much guaranteed, inflation-adjusted income you want if you live into your 80s or 90s. In this example, claiming at 62 pays $168,000 during the 8 years before age 70. After 70, the delayed benefit catches up because it pays $1,350 more every month. Ignoring taxes, investment returns, and cost of living adjustments, the crossover arrives around age 80 and 4 months. By 85, the person who claimed at 62 has collected approximately $483,000. The person who waited until 70 has collected approximately $558,000. That is $75,000 more from delaying, and the gap keeps growing. The bridge strategy uses other resources between 62 and 70, so Social Security can become the larger lifelong income stream. You are not creating free money. You are exchanging liquid assets today for a stronger government-backed income floor later. That can reduce the amount your portfolio must provide in advanced age when returning to work may no longer be realistic. This strategy is even more important for the higher earner in a married couple. When one spouse dies, the survivor generally keeps the larger of the two Social Security benefits rather than both. Delaying the higher earner's benefit can therefore protect the surviving spouse, who may face many of the same household expenses with one less check. Filing early is not always wrong. A shorter life expectancy, no liquid assets, high interest debt, or an urgent need for income can change the answer. The mistake is using age 62 as the default because a layoff frightened you 2 years earlier. Subscribe if you want the math before the panic. Panic is an expensive financial advisor. Be careful with part-time work after filing. In 2026, someone under full retirement age for the entire year can earn up to $24,480 before the retirement earnings test begins withholding benefits. Above that limit, Social Security generally withholds $1 for every $2 of earnings. The withheld amount is not necessarily gone forever because the benefit is recalculated at full retirement age, but filing and returning to substantial work can create unnecessary complexity. The third document is not one document at all. It is the pile formed by your COBRA election notice, Affordable Care Act marketplace application, tax projection, and Medicare calendar. This pile contains the $14,000 invisible bill. At 60, you have 5 years before Medicare eligibility. COBRA usually lasts only 18 months after employment ends. It preserves the employer plan, provider network, prescription coverage, and progress toward the plan's deductible. But you usually pay the entire premium plus an administrative charge of up to 2%. The price shock happens because you never saw the employer's contribution on your bank statement. The average family premium for employer coverage in 2025 was nearly $27,000 per year. Workers paid an average of about $6,850 directly, while the employer covered the rest. Under COBRA, the former employee can be charged the entire premium plus 2%, which is roughly $27,500 a year. Using that average, imagine your coverage ends at the end of April. Keeping average family COBRA for the remaining 8 months costs roughly $18,300. At your old employee contribution rate, those 8 months would have cost about $4,600. The difference is approximately $13,700. That is the $14,000 invisible bill. It was always part of your compensation. The layoff makes it visible. COBRA can still be the right choice. If you have already met a large deductible, are in active cancer treatment, have a scheduled operation, or need doctors who are absent from marketplace networks, the continuity can outweigh the premium difference. A cheaper plan that does not cover your care is not cheaper. Each qualified family member has an independent COBRA election right. You do not necessarily need one answer for the entire household. One spouse might keep COBRA for continuing treatment while another uses a marketplace plan. That detail is buried in the rules because apparently the system prefers families to learn insurance law during a layoff. You generally have at least 60 days to elect COBRA, measured from the later of losing coverage or receiving the election notice. After electing, you generally receive at least 45 days to make the initial payment. Coverage is commonly retroactive to the loss of the employer plan once the required premium is paid. so the first bill can include several months. Do not treat that window as free coverage. It is a decision window with a potentially large retroactive invoice attached. The marketplace has a different 60-day clock. Losing job-based coverage creates a special enrollment period, and you generally need to select a plan within 60 days of the loss. Marketplace coverage can normally begin on the first day of the following month. If you elect COBRA and later cancel it voluntarily outside open enrollment, that cancellation may not create a new marketplace enrollment right. Missing the original window can trap you in the expensive option. Marketplace subsidies are based on expected annual household income, not the size of your current paycheck. For tax purposes, the relevant figure is modified adjusted gross income. Severance can increase it. Traditional retirement withdrawals can increase it. Roth conversions can increase it. Realized capital gains can increase it. Tax-exempt interest and the non-taxable portion of Social Security can also enter the marketplace calculation. This creates the strangest coordination problem in early retirement. The same low-income year that looks perfect for a Roth conversion may also be the year when a conversion reduces your health insurance subsidy. In 2026, the temporary expansion of marketplace tax credits has expired. Eligibility generally ends when household income exceeds 400% of the federal poverty level for your household size. That threshold varies by family size and is different in Alaska and Hawaii. If your final household income exceeds the limit, you can lose the entire premium tax credit. The repayment rule is harsher now as well. For tax years after 2025, there is no longer a cap limiting how much excess advanced premium tax credit you may have to repay. If the marketplace subsidizes your coverage based on an income estimate that turns out to be too low, the full difference can be added to your tax bill. So picture the sequence. You are laid off, receive a large December severance payment, enroll in a subsidized marketplace plan, sell appreciated investments for spending money, and complete a Roth conversion because somebody said low-income years were good for conversions. Each move may look reasonable alone. Together, they can push household income over the subsidy ceiling and create a health insurance repayment worth thousands of dollars. The correct comparison is not COBRA premium versus marketplace premium. Compare annual premiums, deductibles, maximum out-of-pocket exposure, prescription coverage, provider networks, tax credits, and the income decisions required to preserve those credits. Then run a healthy year scenario and a high medical use scenario. Insurance is not a monthly subscription. It is a transfer of risk. Here is the part that never makes it into a retirement calculator. Knowing the COBRA price, the marketplace subsidy, and the Social Security claiming ages does not give you a system for coordinating them. I built a digital book called The Exit Code because these decisions are scattered across documents that were apparently designed by committees allergic to plain English. It analyzes 50 years of retirement data and turns it into a mathematical framework for exiting the rat race. For this situation, the important pieces are the $14,000 invisible bill, the Social Security bridge strategy for delaying benefits without going broke, and the 58% rule for building a buffer against a forced exit. It is research, not motivational wallpaper. You can get it for less than a dinner out through the link in the description. Then come back to the healthcare math, because one badly timed Roth conversion can cost more than the book many times over. That advice is incomplete because it treats the accumulation phase as the whole game. A large pre-tax account can make you look wealthy while giving you very little control over taxable income once every spending dollar requires a distribution. A layoff at 60 creates a planning window that employment was hiding. Your wages fall. Required minimum distributions are still years away. Social Security has not started. You may now have room for Roth conversions at lower federal rates, but healthcare subsidies place a price on every extra dollar of modified adjusted gross income. It is the amount that minimizes lifetime taxes after accounting for marketplace subsidies. An extra $10,000 converted could generate federal and state income tax, reduce a premium credit, and increase the amount you must pay for insurance. The combined marginal cost can be far higher than the tax bracket printed on a chart. This is also why severance timing affects more than the severance. Moving a payment into January might reduce 1 year's tax bill, but it can also raise the following year's marketplace income. A company-paid COBRA benefit could let you accept that income without sacrificing a marketplace subsidy. Alternatively, receiving the severance in the working year may preserve a clean, low-income year afterward. There is no universal best month. There is a coordinated answer. At 60, Withdrawals from a 401k or traditional individual retirement account are no longer subject to the normal 10% early distribution penalty because you are past 59 and a half. The withdrawal is still generally taxable. If someone slightly younger loses a job during or after the calendar year in which they turn 55, a separate rule may allow penalty-free distributions from that employer's qualified plan. That exception does not automatically follow the money into an individual retirement account, so rolling everything over without checking can remove useful access. Do not confuse access with affordability. The ability to withdraw $100,000 does not mean doing so is tax efficient. Large withdrawals can affect income tax, marketplace credits, capital gains rates, and later Medicare premium calculations. Cash, taxable brokerage assets, Roth money, and pre-tax accounts do different jobs during the bridge. Now the wealth claim becomes less mysterious. Consider someone planning to work from 60 to 65 because that is what responsible adults are told to do. They have retirement savings, but no withdrawal plan. They expect to claim Social Security at 62 because their parents did. They assume health insurance will cost whatever was deducted from their paycheck. They have never modeled taxes across multiple years. A layoff forces that person to open the documents. They discover $69,000 of severance that would disappear if they resign voluntarily. They negotiate employer help with health premiums. They use the bridge instead of claiming Social Security at 62, creating a benefit that can be about 77% larger at 70 in the example we used. They manage marketplace income rather than paying the full COBRA premium for 5 years, which COBRA would not cover anyway. They convert selected pre-tax money during low-income years instead of allowing the entire account to become a future tax problem. That person can finish with more spendable lifetime wealth than an employee who earns for longer but coordinates none of it. More salary does not guarantee more retained wealth. Taxes, insurance, benefit elections, and behavior decide how much of the salary survives. To be clear, a perfect clone who works 5 additional years, saves aggressively, and optimizes every rule will probably have more financial assets. Losing a job is not a wealth hack. The real comparison is between the plan people imagine and the behavior they actually follow. The imagined plan is 5 years of disciplined saving. The actual plan often becomes lifestyle inflation, automatic benefit claiming, delayed tax planning, and another year of refusing to calculate the retirement date. I have spent more than 10 years running my own business around accountants and tax lawyers, and I have multiple hundreds of thousands of dollars invested. The pattern is remarkably consistent. People obsess over investment returns because the number moves every day. They ignore benefit elections and tax timing because the paperwork is boring. Then one permanent decision wipes out years of portfolio optimization. The market is not always where the biggest risk lives. Sometimes the largest risk is signing a severance release too quickly. Sometimes it is claiming Social Security because your identity cannot tolerate an empty checking account deposit. Sometimes it is creating an unexpected marketplace repayment with a December capital gain. Your spreadsheet does not feel rejected when a company eliminates your position. Your brain does. That emotional distinction is why intelligent people turn a solvable retirement transition into an emergency. A job at 60 is more than income. It is routine, status, social contact, and evidence that you are still useful. When it disappears, the instinct is to replace the job before examining whether you need another one. You can spend months chasing a comparable title, accept less money under worse conditions, and delay a retirement that was already affordable because work had become the measuring device for your value. That is the unretirement paradox. Some people return to work because they need money. Others return because they built a financial plan without building a life. A forced exit can reveal both problems early enough to solve them. The answer is not sitting on a beach forever. It might be consulting, part-time work, volunteering, teaching, building a small business, or doing nothing productive on a Wednesday without asking permission. The financial bridge gives you the freedom to choose work for meaning rather than health insurance. 1 more year sounds cautious, but it is often procrastination wearing a tie. There is always another market risk, another expense, another target number, and another excuse to postpone the calculation. Meanwhile, healthy years are not stored in a brokerage account. They are spent whether you notice or not. The layoff breaks that loop. It replaces a vague retirement plan with fixed dates, actual premiums, a written severance amount, and a Social Security decision you can calculate. What felt like the destruction of the plan can become the first moment the plan is real. Lazy investing built more fortune than crypto memes. But the deepest advantage is not laziness. It is refusing to make permanent decisions during temporary panic. Getting laid off at 60 does not automatically make you richer. It gives you access to a set of choices that most people never examine until the opportunity has expired. Read the agreement, protect the bridge, and let the numbers decide whether your career ended too early or exactly when your life needed to begin. It gives you access to a set of choices that most people never examine until the opportunity has expired. Read the agreement, protect the bridge, and let the numbers decide whether your career ended too early or exactly when your life needed to begin.